Hello everyone and welcome to Momentum channel. My name is Mo, and today in this video we're going to be sharing with you our plans to retire early thanks to investing in the stock market through a growth and dividend stock market portfolio. I'll be walking you through the exact holding in our portfolio as well as the expected dividend income that we have here. Let's get into it. Now, last week we had an amazing week for the stock market with Nasdaq index going up by over 8%. S&P 500 showing a positive return of 5.7%. The Russell 2000 index being up by 4.5%. And lastly, the Dow Jones going up by over 4%, which is just incredible return. That translated into some really nice gains for our own stock investment portfolio. It's mainly invested through passive investing by investing in high quality index funds and index ETFs. For those of you who've been following our journey, you know that our main holdings include the VDY or Vanguard FTSE Canadian High Dividend Yield Index ETF. This is our largest holding. We have 47% of our portfolio into this ETF, or up close to $155,000 invested in it. Our next big holding is VEQT. It's our Vanguard All-Equity ETF Portfolio, which belongs to our Smith Maneuver account. We have 24% of our portfolio in it, or about $79,000. Our next big holdings is VFV, or Vanguard S&P 500 Index ETF. It gives us exposure to the 500 largest US stock. We have 73,000 almost invested in it, or about 22% of our portfolio. Of these top three holdings, two of them are in positive gain, with showing a 4.3% gain for VDY and 2.8% for VFE. However, our VEQT is down by 8.4%. Following that, our next big holdings is XEQT, or the iShares Core Equity ETF Portfolio. We have $8,000 or so invested in XEQT, and it's up by 3.9%. Then we have some investments in Canadian banks. More noticeably, we have currently shares of Bank of Nova Scotia, Royal Bank of Canada, and Toronto-Dominion Bank. We used to have some shares of Manulife, but over the past week, we sold them at a profit. We also trimmed down some of our shares of Royal Bank and Toronto-Dominion Bank. So we now have less shares of Canadian banks. The main reason for doing so was that we are already getting exposure to these Canadian banks through our investments in the VDY ETF. So there was less reason for owning these Canadian banks separately on their own. We do currently still have about $6,000 invested in Canadian banks, or about 2% of our portfolio, and it's up by 4%. Our next big holdings is in XDIV, or the iShares Core MSCI Canadian Quality Dividend Index ETF. With XDIV, we are invested about $4,500, and it accounts for about 1% of our portfolio. It is up by 1.3%. Our next big holding in our account is XEF. It's one of our most recent additions. XEF is indeed iShares Core MSCI EAFE Index ETF, gives us exposure to international markets. It actually excludes the North America, like Canada or US. It does not have any of exposure to that, and rather gives us exposure to Australia, India, Japan, and some of those markets that we have here. We do have about 1% exposure here. Our goal is to bring it to a higher exposure of around 3%. Currently, XEF in our portfolio is up by 3.6%. Lastly, our smallest position is in ZEB, or BMO Equal Weight Banks Index ETF. It gives us exposure to almost equal exposure to high quality Canadian banks, the top banks in Canada. We have only 38 shares of it, and it's up by 7.7%. The plan is to maintain this ZEB at a smaller portion. There's a chance that we might be selling it and in the next few weeks, and just use the money to instead invest in VDY, because VDY already is giving us exposure to high quality Canadian stocks that do pay dividends. Last week, there was a question from one of our viewers asking us to provide some breakdown of geographical exposure. Currently, our geographical exposure by investing in these index funds and ETFs that we have gives us 58% exposure to Canadian companies, 34% in exposure to US stocks and US businesses, and 8% only in international businesses, excluding Canada and US. Our goal in terms of the target is to bring the Canada exposure down to only about 50%, then maintain the US exposure at about 30%, and the remaining 20% we want to get that exposure to international markets, excluding Canada and the US. In terms of our total invested in the market, we have put in $328,860 by cost basis into the market. It is now showing a total value of $330,904, or up by just over $2,000. Our portfolio as a whole is up by 0.6%, just shy of 1%. Not the greatest gain as a whole, but keep in mind our Vanguard All-Equity ETF Portfolio, which is our Smith Maneuver portfolio, is actually dragging this portfolio down quite a bit. Our goal is to continue to add more to our shares of VEQT and bring the cost average down. And we're confident that the market is going to turn around, as we have seen in the last week. And over the long term, we are going to see much more profits here. As pointed out earlier on the onset of the call, this is a combination of a dividend and growth portfolio. Dividend in the sense that you notice almost all of these positions do earn us some dividends, some at much higher yields, such as the VDY or the Bank of Nova Scotia, as well as the shares that we do see for XDIV, like we are getting close to that 3 to 4%. We have also some Canadian banks, RY and TD, at around that 4% mark in terms of dividend. But we do have some ETFs that they are not mainly for dividend gains, such as the VEQT or VFE. Their intention is more so focused on the growth. And that's where you're starting to notice how some of them we are also gaining some of the profits. The green ones are all our positive gains. What's funny is that for VDY, although it's geared towards dividend, we are also seeing a massive gains. Between the two accounts, we are seeing that close to $6,000 that we see. So VDY that I have for myself, as well as the VDY that we have for my wife. That's something I want to point out, but we are counting both in terms of the profit as well as the dividend income. You notice from our last week's updates that our total dividend income has grown drastically, currently showing a total dividend amount of $9,000, $9,156 to be more accurate. That's our average and dividend amount for the whole year. If we divide it equally by 2, that gives us an average dividend amount of $763 per month, which is a massive increase compared to last week's video, whereby we had only at $600. This has been accomplished by adding more funds to our portfolio and buying more shares of the dividend-paying ETFs. On top of that, last week we earned some dividend income, and we repurposed those dividend income and use them to buy more shares of these high quality index ETF funds. What this portfolio stands out at the current state is that it gives us on average about $25 in dividend income per day, which is just incredible to think about. This is without us necessarily doing anything, and just by holding these funds in these high quality positions. Now, our approach to ensuring that we can reach that early retirement is twofold. First is making sure that we maintain a high savings rate. As the income comes in, as we work on our day-to-day jobs, as well as our side hustles, we want to make sure that we set aside enough money. We pay ourselves first by putting aside the money and investing it in the stock market continuously and gradually, but surely we want to do that. Now, the second way that we want to accelerate our plans to reach early retirement and financial freedom is by making sure that we keep track of all of our costs. It's so important for you to manage and be on top of your costs and expenses and know where you are spending money. Is that something that brings you happiness? Is that something that is actually a need for you? Or is that more so something that it's a nice thing to have, and maybe you don't absolutely need to spend money on that? It's an important and subtle differentiation, but something that really can help you drastically. As you manage to differentiate between those two and cut on your costs, it will really accelerate your plans to reach to that financial freedom and financial independence, because you can repurpose that funds and you can put it in the market so that the money works for you. Seeing that money almost as a soldier that can go to war for you, almost for a good war, in a war that they're actually working for you. They are almost your workforce that not only bring back at the end of the day, additional money, but also you're getting that compounding interest that can grow itself more and more and more. It's almost like that snowball effect that can work to your advantage over the long span of time. That's how we are seeing in our case. We are seeing as we are putting more money, how this is all actually working magic, and we are seeing the dividend income is growing. We are seeing how the profits are growing week after week. Now, there are weeks that the market is not going to do so well. We might actually see the total value of our accounts drop, but we are in it for the long term. We are not in it just for the short term. We have that long-term mindset, and I think that's something very important for those who are investing in the stock market. You shouldn't just be blindly putting in the money and expect your money to increase rapidly overnight. That's not really the game plan. The game plan is being in the market for the long term, and knowing that over the long term, you're going to get those nice average gains if you're invested in the right set of stocks, in the right set of funds, as we share with you some of the funds that we are, for instance, invested in. Those are our best picks that we have. Again, I encourage you to do your own research and do your own due diligence before buying any shares of stocks or any shares of any ETFs or index funds. If you are interested in opening an account, and perhaps you are based here in Canada, I do definitely encourage you to check out the Wealthsimple Trade app or a brokerage account. It actually allows you to buy these shares. A majority of our funds are in fact bought through the Wealthsimple Trade, because there's no fee whatsoever, no commission fee to buying Canadian stocks or ETFs. Same goes for buying US stocks. You don't have to pay a fee, though there is a conversion fee that you have to pay for when you're buying those funds through Wealthsimple Trade. We have a referral link in our portfolio. Be sure to check it out. We will add it as well as a pin to this video. If you do use that, you're going to get an option of gaining some sort of referral bonuses that are massive. I do encourage you to use that. As always, if you enjoyed this video and are encouraged and inspired to pursue financial independence and financial freedom for yourself, be sure to subscribe to our channel, because here we do talk about this topic extensively. We also have many videos that we make every week talking about investing, including investing in dividend stocks, growth stocks, and penny stocks, as well as ways to reach that financial independence. I hope you enjoyed this video. Leave us a comment down below and let us know where you are in your own journey to reaching financial independence. This really helps us grow a community of like-minded individuals who are passionate about the same topic. Thank you so much for watching this video until the end. I really appreciate it, and I hope to see you all next time.